Thanks, David. What I'll be talking about today is our outlook for Australian corporations and their funding options in 2014, but I want to focus on a particular trend that we're seeing in this market, which is the Term Loan B market and the rapid increase in the non-investment grade credit ratings that we're currently assigning. So currently, at the moment, for every three new ratings, we're doing about 2 are in the single B category, and the other one is either triple B or double B, in that sort of range. So I'll just give you a snapshot in the 20 minutes that I have of why corporates are looking to go to that market in the US at that single B level. Okay. What we do every quarter is we put up a snapshot of the credit trends in Asia. What I've tried to do is take out of the most recent credit trends back in December how we view each sector relevant to Australia. So these are the sort of major sectors that are relevant to Australia. As you can see there, current business conditions are all satisfactory except for metals and mining. We believe the weak business conditions in the metals and mining sector is primarily due to the reduction in capacity in China and oversupply in certain minerals. This will bottom out in 2014. It's our expectation that that will occur. In terms of financial trends, what we're seeing here is the REITs have higher financial trends. It's probably a function of their willingness to use debt. We're seeing quite sizable M&A activity in the Asia Pacific. Dexus taking over CPA, Westfield looking to reinvent itself. So that's what we're seeing there from financial trends. And in terms of sector outlook, most are on a stable outlook. So our sector outlooks are 12 to 18 months time frame. Most are on a stable to negative, and as I indicated before, probably we have a more negative bias on our metals and mining sector, which is probably indicative of the negative outlooks that we have in that sector. Okay, in terms of the debt mix in Australasia, we have 140 corporates that we rate in Australia. We have 540 in Asia, so 140 out of that 540, it's quite a sizable number in terms of pulling our weight here in the Asian region. And as I said, it is growing, and growing quite fast in the single B territory, particularly because of the Term Loan B market. There was, in my caption to my speech, there was a request to sort of bring about some global comparative analysis. What I can say is that out of that 140 credits, we have an average rating of triple B plus A minus, sort of on the cusp of that level. Globally, our average rating is around the double B plus level, so we're about a category above the global average in Australia. It's not because we have better corporates than globally, it's because the population of credits that we're rating are skewed towards the top tier. So we're probably reaching a saturation point in terms of the investment grade space in Australia. If we had a more viable corporate bond market, we probably would see more corporates coming to the bond market as they do in the US and in Europe, and therefore our average rating would trend down towards that double B plus, triple B minus cusp. Gradually the rating is moving down because we're rating more and more single B entities because of the Term Loan B market. Within this graph here, though, what we're highlighting is the mix of debt in our 140 corporates via the major sectors. Clearly, the materials and energy sector is the largest debt issuer, and they do predominantly use debt capital markets to fund their business, as distinct from bank debt. By contrast, the next biggest is consumer-related corporates, who tend to use bank debt more than debt capital markets, and it's probably a function of the rating levels in the consumer-related corporates that tend to be a mix of non-investment grade and investment grade. So the non-investment grade guys really are restricted from raising debt in the local market. But clearly, long-dated assets are supported by debt capital markets issuance, as evidenced here by the Aussie utilities, project finance and real estate sector. What I wanted to cover off now is just this Term Loan B phenomena that's occurring at the moment. So I'll just give you a background as to how we come out at our single B ratings that we're currently assigning. So we start with an issuer rating, which is our opinion of the risk of default. What we then do in the non-investment grade space is we perform a recovery rating where we estimate the nominal recovery of principal, assuming the corporation defaults. And that then comes, the combination of that issuer rating and recovery rating derives the issue rating, which is that risk of default and loss given default. Some recent examples of where we've applied this notching and recovery, and these were to bank loans actually. What we're showing here is the issuer rating there in that second column. The importance of that is that's the anchor, that's the probability of default. The loan rating is the actual issue rating, and that in these cases is sometimes higher than the probability of default. So it's showing that if you had a secured lend to Federation or New Farm, you would have, at the point of default, a higher prospect of recovery relative to unsecured creditors who would be at the issuer credit rating. The recovery rating on the very far right there is an indication of the capacity, the actual percentage of recovery that we would expect at the point of default. So what this indicates here is that we are looking at this from a holistic perspective, looking at the capital structure of the corporate and where the various tranches of debt sit within the corporate and how we view that debt. Interestingly, Qantas Airways, that was, I think, prior to Christmas, we took them from BBB- down to BB+. As we transition out of investment grade, we are required to perform our recovery analysis because in the non-investment grade credits, recovery becomes more important, except, there's always an exception, in utilities and in REIT space, we actually do perform recovery analysis for REITs, as evidenced by that Federation centres there at the top, where we actually allow for notching up based upon security provided to a REIT or to a utility, and that notching up is based upon the level of over-collateralisation of the secured debt. So what's a Term Loan B? So here's what seems to be the flavour of the month was for 2012, for 2013 was keeping us very busy. The tenor for these Term Loan Bs have been typically 5 to 7 years. They're covenant light. They have less restrictive incurrence-based financial covenants, as distinct from maintenance-based covenants for a lot of the traditional bank loan funding that you would be familiar with. They are preferentially priced, I think, in line with the degree of likelihood of the issuer's recovery following a hypothetical default. And generally, they offer up security. So these have been very popular with high-yield issuers in Asia, as well as the Australian mining companies. And a lot of this appetite has been derived from the institutional market in the US. And as evidence, you can see the growth in this market post the GFC. Clearly, in 2013, we surpassed the pre-GFC volumes. So the annual volume has returned to the GFC levels. There's a record level of new money deals in 2013, and it's actually driving a lot of the corporates that we're seeing in the single B level to go to that market to access this cost-competitive funding. And why is it getting more active? The US and Euro banks have obviously less appetite for loans due to high regulatory capital and liquidity requirements. The instos are searching for yield because treasuries are so low in terms of absolute returns. So, this is why we've seen this re-emergence of these covenant-light transactions. And these are some examples of some of the TLB issuance in Asia Pacific. Some big names there, the Fortescue $5 billion issue. That was, I think, one of the landmark issues last year. I think these were for last 12 months from memory. But yeah, $5 billion into that market. We actually, for Fortescue, we had the benefit there of security of the asset. So there was a notching of 2 notches for that particular secured bank line, or secured TLB issuance, and they got that debt away at BBB minus. Just recently, we had Census, which was spun out of Telstra. They raised $315 million in the TLB market. They were a single B credit. We've also had Emeco Holdings last week go to the market. They're a single B plus. Emeco do equipment hire, equivalent to Coates. So they're a B plus entity. But this is just a smattering of these entities. It's probably fair to say some of these entities that are going to the market are coming out of the private equity space. All that bank debt that was put in place pre-GFC is now coming up for maturity, so the private equity guys are looking to access that market. So finally, what do we view as the outlook for 2014? If we start at the top there with the regulatory cost of capital bubble, that's probably the first reason why markets like the TLB market is becoming more robust. What we're also finding is that banks will continue to satisfy the majority of the funding requirements in APAC. So Asia Pacific is still very much a heavily banked market. The bank market here is probably the 3rd biggest in Asia, behind Japan and China. And as we're seeing, our 400 credits up in Asia are still heavily banked by the local banking system. But having said that, if you go down to the 3rd bubble there on the right, banks are looking to leverage credit ratings and use these ratings in pricing grids, in review events and so forth. So we're picking up lots of bank loans now that do reference ratings. And we're also seeing some institutional participation in syndicated loans, which will grow slowly. It won't grow very fast in Asia because of the sheer volume of bank lending, but we're seeing some evidence of that occurring here in Australia. I think Eastlink had the IFM participating in a bank loan there. But banks, obviously, because of the regulatory changes, are looking and encouraging a lot of corporates to access capital markets and becoming much more capital market intermediaries. And you'll probably hear that from a number of the bankers that will follow my conversation to highlight that. So on the basis of the 2014 outlook, it's still very busy at S&P, but we're becoming more familiar with the single B space and sort of the credit risks that come with being a single B credit.